President Trump's trade deals will result in the average tariff rate on goods imported into the United States increasing from less than 2.5% last year to roughly 20% by the end of this year. That's a radical change in trade policy that will put U.S. tariff rates at the highest level since the 1930s. This video will consider whether those tariffs will cause a spike in U.S. inflation and the implications for interest rates, monetary policy, and asset prices if they do. Topics covered in this video include who will ultimately bear the cost of the tariffs? Will tariffs cause a brief spike in prices or ignite a prolonged wave of inflation? How the Fed forecast inflation by analyzing the three component parts of the inflation index and what trends there suggest about the outlook for inflation. How wages, labor supply, and reindustrialization are likely to influence future price trends. Why tariffs may very well lead to the Fed's loss of independence, and how all this is likely to impact asset prices and your wealth over the months and years ahead. Tariffs are a tax on imports, but who will bear the cost of these taxes? It's certain that whoever imports the goods into the United States, companies like Walmart and Nike, will pay the tariff tax to the U.S. government when they collect those goods at U.S. ports. But that doesn't mean that the importers will bear the cost of the tariffs. There are other possibilities. First, the importers could persuade the foreign manufacturers from whom they buy those goods to reduce the price of the goods before they reach the U.S. Second, the importers could pass on the cost of the tariff tax to the consumers.